Hi, Larry Gaines, PowerCycleTrading.com. In this video, I want to show you what we call divergence. Okay, so I'm going to show you some seasonality patterns and show you where the market starts to stall out based on seasonality tendencies, and then we're starting to see a divergence come in between the weaker component, which is the Russell 2000 versus the NASDAQ 100. So first off, these are seasonal continuation patterns here. So this is the NASDAQ 100, and you can see here this goes back 5, 15, and 20 years. There's a really good strong seasonal trend to the upside that pushes the NASDAQ 100 type stocks seasonally up until we get to this week we're currently in, so the week of option expiration for the monthly. So this tends to peak out around the 20th of July. All right, so we're into that week right now, and so we could eventually start churning sideways on the NASDAQ 100. Now the next chart is the seasonality chart on the S&P, and it too tends to peak out seasonally. The trend tends to peak out this week of the 19th monthly expiration, and then will either churn sideways to down or pull back even further into August. And then when we look at the Russell 2000, it peaks out, like earlier, sooner. So this was basically peaking out last Friday, and then it has a potential for a bigger, stronger seasonal trend to the downside. All right, so the question is then, how do you use this information? And one more chart here. Here's the DAX, and you can see it tends to peak out really badly here in the week of this July monthly expiration for the U.S. Options here for the U.S. markets. So you can see the DAX also peaks out. So how do you use this? Well, first off, you can see if we back up here to the Russell 2000, it tends to be the weakest of the U.S. broad market. So a couple of different ways to play it. One way you can play it is to sell bear call credit spreads, and that's something that you can do using the RUT. I'll show you a trade example of that. The other one you could do is do a spread to take advantage of that divergence between the NASDAQ being stronger than the Russell 2000. So let's take a look at both of those types of setups. So the chart here on the left is the QQQ NASDAQ 100 ETF, and you can see how it's made a new high again today, today being the 15th of July. And you can see that the momentum here, cycle 1 and 2, are still positive above zero. Now, when you look at the Russell 2000 IWM, the ETF, you can see it's just churning sideways, and our momentum starting to shift down. So you could take advantage of this. You could go long QQQ, short IWM as a spread. So this is what that spread is currently looking like. So currently going out today, the spread of the QQQ over the Russell is $38.86 per share over, and you can see how much that has really increased from when we look at the back in June. It was about, we'll say, 26 over, and now it's 38. So that's a good 12 points that it's increased, which would be, if you did this 100 by 100, that's $1,200. So that's doing it as a spread. Now here's another way that you could take advantage of that potential for the Russell to churn sideways to go down, would be to do a bear call credit spread, and we can do that using the RUT, which is the Russell 2000 ETF index. So the other way to play this trade is you could sell the 1600 strike. That's like a 20 delta, and basically what you're doing is selling out of the money, one kind of close to one standard deviation point, and then looking for the market to churn sideways to push down based on that tendency, based on seasonality. So if you look here at the daily time frame, you can see that the 1600 is about one standard deviation away, out of the money, and that's basically using this option series, the 2 August series, and then selling it, trying to make like a 25% return on your risk of that credit spread. So by selling this August 2 series, the 1600 short strike right here with the 20 delta, that theoretically is looking to give you a potential of 80% probability or chance that price will close below 1600 over the next 18 days. So setting that trade up today, that was going at selling the 1600, buying the 1605 $5 wide spread, bringing in $1 credit. So your risk is 400 and your potential profit is 800, and that's based on a high probability trade. Now you can see your theta decay is about $4 a day, and that's just going to start increasing more and more as we get into this Friday. That'll be 485 a day. So this way you can take advantage of that potential for the seasonality stalling on the Russell 2000, but you don't have to have the price really go down. It can just churn sideways. All right, hope this helps, and I'll talk to you on my next video update.